All right. Matt, the mortgage guy here. Another episode of Mortgage Broker Q&A. We are live like I am every Monday, 6 p.m. Pacific Standard Time, answering questions that people have about mortgage, about the housing market. Whatever you guys really want to talk about, that's what we're going to talk about. And so that's why each week there's not necessarily a scheduled topic. I know that there's a bunch of different things that people are going to want to ask, and I'm happy to take it wherever it goes. More often than not, we've got people who are either actively looking to buy real estate as their primary residence, they're actively looking to buy rental property, or they're just interested about the real estate market in general. And the questions that they ask, without a doubt, are going to benefit other people watching. And then we've got people in the comments who are, other loan officers, real estate agents, CPAs. They give their intake, they're other real estate investors. And so it's just a good conversation to have. And the best part about it, in my opinion, is when you look for information on the internet, you don't always know how up to date or accurate it is. We're talking about July 2021, what's going on in the housing market, what the mortgage guidelines are, what you can and can't do, what other people have recently done. And so when you ask a question, you're not going to get an answer that's 15 months old or 3 years old searching the internet. You're going to get an answer from me, and I'm going to give you my honest opinion. If I don't know, I'll tell you so. You're going to get other people in the comments who are like-minded investors or maybe a CPA, maybe a real estate agent. They're going to tell you from their experience, hey, I just had a client close on something in June, and this is how they did it. Or I had somebody that just closed on a similar type property in May of 2021, and this is how they worked it. So really good format, in my opinion, for getting yourself up to speed, up to date, finger on the pulse. So what's going on in the housing market, what's going on with mortgage and mortgage guidelines, and all the stuff. Before we jump into it, I just want to give a quick update to anybody who has heard I've got a Mortgage 101 course that I'm putting together. My goal is to put together 11, 12, 14 videos that are going to be the very best of what I've done over these last 460 videos, stuff that can truly help you, save you money, teach you how to read loan estimates, teach you like the do's and don'ts, how you find somebody who you like and trust in your market, what you should do before you get pre-approved, after you get pre-approved, before you buy a house, all that stuff, right? I'm putting together a course. I'm going to make it super, super cheap. And I don't know the exact price right now, but what I can tell you is I've recorded about half of the videos. I've already got them edited, and my buddy Mike Zuber on One Rental at a Time. If you haven't checked out that channel, you probably should. He's an investor, owns about 180 units, retired from the rat race a long time ago, knows a lot about investing, has a book, One Rental at a Time, has a course, One Rental at a Time, and literally advises thousands of investors on how to build your real estate portfolio. Long story short, inside of his course, he's got my content and he's uploading as we go. I won't tell you all of it, but finding a professional you like and trust, doing the pre-approval first, setting goals and a game plan, mortgage jargon, how to read a loan estimate, different loan types, how much do I qualify for, how rates work, finding a realtor and home shopping, should I refinance? That's some of what's going to be in that course. It's going to be great because I don't want to just put out junk, right? So I've spent some time, effort, and energy putting that together. It's probably going to be something like $97. So it's like anything else that you find on the internet. You could probably find all this information. You could peruse my channel through 480 videos and find information that's going to help you if you want a really compact version of that. And you're saying to yourself, $97 might be a good investment if it's going to save me $2,500 on this next purchase of my next home, because I'm going to know how to read a loan estimate. I'm going to know how to ask the right questions, connect with the right professionals. Look for that coming likely August of 2021. So with all that being said, thanks to everybody who's joined. I'm looking forward to having, as we normally do, 50, 60, 70 people on, just firing questions, chatting about real estate and mortgage, and me doing my best to add as much value as I possibly can. Good evening to my buddy Kevin. I appreciate you being on here each and every week. Keep doing your thing out in Florida. Good to see you. Another one out in Florida, Gadenier from Orlando. good evening to you. 9 p.m. out where you're at. Caden, good evening to you, sir. Thanks for joining. This is a good question, Bradley. Best way to search guidelines and get to what you're looking for quick. Different companies have internal guidelines where you can go and, like I remember the old lender I worked at had like an intranet, and you could go search like Fannie Mae 4000.1 guidelines, and just like, what is it, like Control F where it's find, you type in the words like you type in gift funds, and then it would take you to the different spots in the guidelines where they mention gift funds. You can probably do that online somewhere. And as much as this is going to show how long it's been for me, I don't even know what website it is. But I'm just going to Google, like, I think you can go to HUD.gov and you look for that handbook 4000.1. And there's probably a search tool within there. But it's big. And so, yeah, do that. Type in basically, HUD handbook 4000.1 and find your way to the HUD website and see if you can find the guideline there. If you're a lender and you're looking for it for that reason. If you're a consumer, just get yourself to a good quality lender, because the guidelines at times can be daunting and can be written in weird ways where it like almost gets left to interpretation, where you want to talk to the specific lender you're going to work with. How do your underwriters interpret this? And truth be told, you might have a guideline that says one thing and then a lender that says, oh, well, the guideline states that, but here at XYZ Mortgage, we also want you to have 6 months of reserves, or we also want to do this, or we also want to do that. And so it's not necessarily going to be what the guideline says, what the lender requires. The lender, if you hear the term overlays is like, oh, the minimum requirement from Fannie and Freddie is this, but here at XYZ Mortgage, we also require this. And so they're going to have additional guidelines stacked on top of that. Beware of that. Just connect yourself with a great lender. Bradley, if you're a lender, which I don't know, I'm just going 50-50. You're a consumer that's really interested in the guidelines, or you're a lender that's trying to find a specific one. That HUD link is going to be a good one. And here we go. Copy. Let me see if I can put it up right quick. Can I post this? Paste. All right. So I posted that. That should be the handbook. And then from there, you can find ways to search inside of it. Yep, you're a lender. That was my guess, my dude. First, go to whatever company you work for and ask if they have something internal. Because what some lenders will do is internally, they'll have a document that has this kind of coupled with, company-specific overlays or guidelines. Good evening from Cape Cod, Massachusetts. Happy Monday, Maria. Good to see you here. Good to have you back. Maria is our CPA of the group. So if we have anything that comes up, Maria, let me ask you this. I've got a CPA question that a client asked me today. If somebody moves out of their primary residence and buys a new house, are they able to use that prior residence? They want to use it as an office. And so they want to have their S Corp pay $3,000 a month to rent that prior residence as office space. I know that you can, like if you're living there, you can write off a certain amount because you're using office space in 400 square feet of your 2,000 square foot house. But I'm talking about they moved out. They want to rent the whole thing 365 days a year. My guess is that if it's zoned residential, there might be an issue with it. But could they do something like that? Let me know. Thanks for being here. See, I get to ask questions too on this Q&A. It goes both ways. Another Massachusetts. Hello to all of Boston and Lowell and Cape Cod. I like just to say Boston because I got a buddy in Boston. I like it when he says that. Liz, good to have you here. Thanks for the kind comment on my videos. Clarify for me, when you say second home. When you say second home, do you mean investment property? You're going to buy it as an investment, or do you mean second home as in you live in the city and you want to buy a house by the beach as a quote unquote second home? Because second home is different. And, just rough figures, if you're buying something as an investment property and you're putting 25% down, that rate without paying any points today is probably about 3.375. And if you're buying a second home where you can go as little as 10% down, though that pricing is a lot closer to primary residence pricing. So if you've got great credit, that one's going to be sub 3%, 2.9% ish on the second home. So I answered both, but let me know which one and I can confirm it. Oh, sweet, Caden. Good to hear. Good to hear that, if you are trying to connect with a mortgage broker that I like and trust and you're not in California, greatmortgagebroker.com. I'll connect you with a great broker in whatever state you're in. U Mortgage, a great partner of mine, is licensed in a bunch of states. So more often than not, you'll probably connect with them. They just run a great company from top down. I know the president CEO. He's a friend of mine. He is going to make sure that anything that I get sent over, they get taken care of. So that is good to hear. They're going to take good care of you. They're going to get you a great mortgage. So thanks for sharing that, Caden. And I'm glad we're able to connect you with a great broker because everyone's a winner. You're a winner. We're a winner. Everyone's a winner. Currently talking to a mortgage broker that is doing no income check mortgage. This sounds weird. Not that there's no loans out there where you don't have to check your income, but the 1K up front, this is where I'm worried. Don't ever pay anybody anything up front. Humongous red flag. Never, ever should anyone be asking for any money up front on a mortgage. I certainly would not. Nobody I know in the mortgage industry would. So clarify that for us, because a $3,000 cost isn't that bad, but 1K up front is no bueno. Venti, thanks for coming back. Good to see you again. 698 credit score, 450 purchase price, 5% down payment, 15K for closing costs. FHA or conventional 95. PMI probably a bit higher than FHA, but no upfront or lifetime MIP. 3% interest for both. I would definitely go with the conventional loan. And at 698, I wouldn't necessarily assume, if you're putting 5% down, I wouldn't assume that your PMI is going to be more with the conventional loan if you find the right lender. Here's something for everyone to consider. Each lender is different when it comes to mortgage insurance. If you're working with a broker, they've got humongous wholesale lenders that can negotiate smoking rates for mortgage insurance. So I'm just going to do it right now. 698 credit score and 450 purchase, 5% down. Because 0.85 is what FHA is no matter what your credit score, right? And so when you're looking at conventional versus FHA, this is for everyone's knowledge. Conventional is based on your credit score. Great credit score, super low MI. 640 credit score, big MI. For FHA, it's going to be 0.85% monthly, no matter what your credit score is. And so that's why when you're 640 credit score, FHA probably better. But with conventional, you have to look at, okay, I've got a 698. My MI is going to be this. What do I do? Conventional or FHA? Like Venti stated, avoiding 1.75% charged up front on this big of a purchase you've got a $430,000 loan amount. FHA is going to charge you 1.75% upfront. It's like an $8,000 fee. Bam. It's financed, but still it's on there. It's $8,000, a lot of money. So if you can avoid that, you want to. Sometimes it's just so much better FHA because of a 640 credit score that you just go FHA. But what I'm looking at, Venti, is my preferred lender, which I broker a lot of business to, and I won't keep it a secret, United Wholesale Mortgage, 698 credit score, 5% down, my mortgage insurance with them, and they're better than most everybody, significantly better than any retail lender out there, 0.65%. So that's $231 a month on that specific scenario. 0.85 is going to be whatever 0.85 is, $280 a month or something. So it's going to be $50 a month less on the conventional. This is a all day conventional, all day day right here. So I would probably shop the loan. As much as like I almost discourage people from bouncing around to lenders, but you can find a lender where this deal is going to make a lot more sense conventional. If it's more than 0.85 PMI, which it might not be, you might have just been guessing that, and it might not be. But the PMI is cheaper, and you're not paying up front. FHA, the rate should be a lot lower, and that's where it would, you do a comparison. But still, I think I lean conventional on this one for sure, avoiding that upfront and not paying it. Yeah, because FHA on this deal, I'm pricing it right now, 0.85, like I guessed, about $282 a month, but the rate is like $236. So what's that? $1,970. Yeah, the payment's a little bit less on FHA, but you because that rate, but you pay less MI and not that $8,000 up front, which I think is the most important part about the deal structure. Just put them side by side, and then you kind of make a decision on how long am I going to be in either one of these loans. So, all right, vacation property, Liz, sub 3%. And by sub 3%, I mean less than 3%. 2.9-ish is my guess if you got good credit on that one. So go buy yourself a vacation property. Let me know where. I want to live vicariously through you. If we saved up some cash, can we use that for closing on a house on either closing costs or down payment? You cannot. If you're saying cash, then it has to be in the bank and seasoned. And by seasoned, the lender wants to see 2 months of bank statements. If you have cash that you're saying, oh yeah, I'm going to bring it, or I'm going to deposit in my bank account, it's like the U.S. Patriot Act or something, where they're trying to avoid illicit funds being used in real estate transactions. And so they don't know where that cash came from. They don't know if it's mafia money. They don't know if it's cartel money. As crazy as that sounds, they don't know if it came from terrorist organization. Like, that's what the law was designed for. And so, long story short, has to be in your bank account for 2 months for us to be able to use it on a real estate transaction. I was searching for somewhere. I've got something that my team made. It was really cool. Funds. I had like an infographic that my team had made for down payment funds, and sourcing of funds. I'm searching my Dropbox right now, and I cannot find it. But here we go. Mortgage knowledge. Let's see if we can pull this up right here. Share screen. This will answer your question and more. All right. I'll have to zoom in. What is it? Control plus? So what are considered assets in a mortgage transactions? And see, it's funds that have been sourced um, in a bank account, or some sort of account, right? Cash, mattress money, not considered, right? And so in your bank account, we need 2 months of bank statements. If it's a gift funds from a family member or fiance, that gift donor can wire it directly to title. If it's from a 401k or retirement account, again, we need 2 months of bank statements. And then this is just some stuff that we kind of share with our clients. Don't move money in and out of accounts without first discussing with us. Someone will take money out of one account in cash, put it in another account, but it's $300 light because it's, your cousin borrowed 300 and they do something. The moving of cash is not a good thing to do when you're going to be involved in a mortgage transaction. Like, don't deposit cash, don't deposit the gift funds. The gift funds should come directly from the donor to title. Avoid having to, source and show where all the money was moving. That's the same thing it says here. Do not keep copies of, or do keep copies of everything related to money movement, because you're going to have to show it, source it, and explain, like, where did this $3,200 withdrawal go, and what's this $2,800 deposit, and things like that. So the bottom half of this is just the acceptable document formatting, because people want to take screenshots and they want to take a picture from their phone and do all kinds of stuff when they're sending us stuff. Lenders aren't allowing that. And so, little tips and tricks with iPhones and Androids, how you can, send us a scan, which is really a picture, but you can turn it into a PDF, or turn it into a scan. So hopefully that was helpful. That's a little mortgage knowledge assets, a little something the team put together. Got a pretty good team. They're the best. All right, stop sharing. All right, when is a good time to lock in my rates? My closing date is August 25th. Well, I have to admit to you, Jennifer, that I had no idea we were going to trend down in the last 2 weeks like we did. After June 16th, where we saw worsening, 16th, 17th, and 18th, I was scared for rates, and I thought it was the beginning of the end. And I told all my clients, I do not want to risk, with all the volatility in rates getting worse. We should be locking. And really, on refinance and purchase, it was, locking things to avoid further deterioration. And over the 2 week period, like the ending of June, early July, we've seen rates get better. And Friday, they got a little bit worse. Today, they got worse, then they got better. And so I think it's just personal preference. If I was you are about 45 days out, I'd probably lock on a 45 day. And this is your follow-up question. Are rates going lower? Who friggin' knows? Let's do this. Let's pull up something here. MBS Highway. I don't know how we ended today, but my guess is that we were down slightly, because I know it was worse in the morning, and then it got a little bit better. Yeah, so here's a little something. A little something for the people. Share. And just because I'm sure it's small on everyone's screen, way back here is April. Let me zoom in just a little bit. This is mid-April, and then this is today. And when this goes up, it means rates are getting better. So it's like better, worse, better, worse, better, worse, better, worse. And then this is that nasty, nasty end of the week, June 16th through June 18th, where, let's call a 30-year fixed right here at the bottom when it got worse, 3.25. And then it's steadily gotten better, little bit, where we're probably closer to 275, 2875 on the cleanest, most well-qualified clients. Worsening Friday, worsening today, meaning, if you're 760 credit score, putting 25% down, you're probably 2875. Like, do you feel like gambling? That's the question, Jennifer. Do you feel like gambling? If you can get that sub 3% rate, I don't know your credit score, I don't know your down payment, I don't know all of it, right? But if you can lock in something good, I think you lock. Because what happens if this, little bit of a downturn we saw Friday and Monday, what if that's like this, boom, and then we're a quarter or 3/8 worse than we were right here? It can happen. I mean, it happened from like the end of one week to the end of the next, like from June 11th to June 18th, wha-bam. So, if you're like, what, I'll wait until I'm 30 days out, then decide, you might be 3/8 worse. And I would not want to gamble that. Depending on how much you're buying, it might be $100 a month, might be $150 a month. So if you like it, lock it. Final answer. Stop sharing? What happened? Back to me. All right. Linda Fernandez, another regular. I appreciate you. Thanks for stopping by. Sorry, I read this one before I put it up here. No income mortgage where I get the mortgage. I give them $3,000. Is it responsible to give them cash? No. Your second question was very similar, but it says, is it reasonable to give them cash? Same answer. No. Granted, I don't know much about this firm or this, but you can get, when you say no income mortgage, there's debt service coverage ratio loans. There's like a bank statement loan where it's like you don't show tax returns. You just show that there's deposits every month. Those kind of loans function similar to the conventional loans I'm doing, where you get into contract, you put an earnest money deposit down, you order an appraisal, everything goes along, and then at the end, like the lender is getting paid, or the broker who does the deal is getting paid by the lender. Like, you're not paying anybody up front. Paying up front just sounds bad. I would run, and I would run fast. I mean, I used to manage a poker room, and this to me is like, reminds me of some underground stuff, right? It's like, you got to go with a brown duffel bag and you got to pay somebody $1,000. They're going to get you this loan. I don't like it. Mr. Lynn, not one bit. So my advice is, do not give anybody any cash up front on any mortgage transaction. Thanks for sharing, man. Report back to us. Let us know what you end up doing. My advice is no money up front. Zeta, how you doing? Great question, Zeta. Not many companies are doing this lock and shop, because what you're referring to is like, how long can I lock while I'm looking for a house? Not many lenders at all. None that I know of are going to allow you to lock while you're shopping. They're going to allow you to lock once they have a full application. They've got all your docs. They've got a purchase contract that's fully executed. Everyone's signed. You're in contract. That's when you can lock. If it's a new build, it's similar, where like once you've signed and you're in contract to buy, then you're able to lock. But any product that's out there that's a lock and shop is going to be horrendous. It's going to be similar to like these 180-day locks or 360-day locks I see. If the market rate is 2.8, they're going to say, oh yeah, we got it. We got the lock and shop. Just lock it in at 3.375. It's good for 180 days. I wouldn't do that. Not in a million years. if rates get that much worse, so be it. But don't lock into that. Find a house 2 months from now and then find out you could have got a 299 or a 2.875. Erica, thanks for joining. Just sold and looking to buy a vacation home out of state while hopping into a rental as my primary. Can I pass the vacation home as a primary since it would be my only home that I own? Well, I had this question asked in a different way last week, and my answer is always going to be the same as a licensed mortgage professional who values my license, NMLS number 1088993. You're only going to buy a primary as a primary if you plan to make it your primary. If you're going to live there, great. If you're buying something on the lake in another state and your job is wherever you're living now and you don't really plan on moving there, but you're like, oh, interest rates are great on a primary, then that's mortgage fraud. That's bad. Good news is vacation home rates and primary rates are very, very close. If a primary is 2.8 for your specific scenario, the vacation home is probably 2.9. So solves that. You don't have to lie awake at night thinking whether or not you should do the right thing. Do the right thing, and the pricing's very close. Linda Gomez, hello, hello, hello. She'd like to say hello to everyone. Oh, cash? Yeah, cash. If you want to use it for a mortgage transaction, put it in the bank and let it sit there for 2 months. If you don't, then it cannot be used. All right, Venti, here's a follow-up. Riverside, California. Let's do it. I generally, don't like to take business where somebody's already got a relationship built. But in this case, builders, lenders, find a nice way to say it, Matt. Play nice. Just the way that they operate, like kind of forcing you to use them. And from the past, where I've seen like strong arming and existing relationship with a client who's a long-term client being like ripped away from a builder's lender, I go hard on builder's lenders. So we'll offer you a better rate, Venti, even if I gotta cut comp or something to beat this builder's lender. Let's do it. Let's get you the smoking rate. Because truth be told, I made videos on this. Builder's lender, outside lender that you want to use or that you met or that you're just comparing to. I've given plenty of people advice like, yeah, with that $7,500 incentive that the builder's giving you for using their lender, go ahead on. You're better off with them. And it was 2019. It was like 50-50 was who could get the better deal. The builder's lender with an incentive or me without an incentive. And I was like, half the time I'd win, half the time I'd say, just stick with them. You're good. 2020, probably similar, 50-50. Maybe I was 60, they were 40, where, hey, they're offering you a $7,500 incentive, but I'm $8,300 better without any incentive. So I'm going to save you $800 coming over here. 2021, I have seen builders slowly decrease that incentive. Call it whatever you want. Call it greed. Call it just them playing by the market rules. We're like, listen, we don't got to give it away because we've got such high demand. People are desperate. They want to do whatever we say to close on this new build because demand is so high. They just want to get on our list and they want to get this thing closed. Builders lenders incentives now are like $1,500, $2,500. With that little tiny incentive, mortgage brokers are usually able to blow them out of the water because the builders lender, like Lennar, they changed it from Eagle Home Loans. Now it's the Lennar Home Loans. Rates and terms suck. A lot of other builders lenders that they partner with charge big margins. That's why they can give that little incentive or whatever, whether the builder owns them or not. They just are generally more expensive. So my guess is that we'll be able to beat them. So yeah, shoot me a message. And really all you got to do is shoot me a loan estimate whenever you get, let's call it 45 days out. Even now you're 60 days out. I'll look at it, man, and I'll just send me one the day of. I'll price it the day of, and I'll tell you, man, that's a pretty good deal. just stick with it, especially if you've got everything in with them and it's all squared away. Then no need to like switch if it's like a $300 difference. But if I'm saving you $2,200 or my MI is significantly cheaper and the terms are significantly better, then by all means, let's do it. Are the rates higher for a no income mortgage? Yeah, for sure. Those type of non-QM loans where it's based on the debt service of the rental property, or it's based on income, like bank statements or anything else like that. If it's not a conventional loan, you can expect higher rate, higher fees. I mean, that's just the nature of the beast. It's a riskier loan. And these non-QM lenders, they don't have the ability to package these things up and sell them to Fannie and Freddie, a subsidized government entity, right? And so the terms are going to be not as good. 4% is really good. Some of those loans, depending on the loan to value, depending on the credit score, depending on the type, are anywhere between 4 and 6%. So 4% would be on the lower end for something like that. All right, Maria, for that S Corp question, sounds like it would be very difficult to prove the S Corp is using the whole house as an office. I'm telling you, I mean, it's a legit scenario. It's a legit scenario where a client of mine is like, I could rent 1,000 square feet of office space for $3,500, or I could upgrade my house and rent my old house as office space from myself and pay $3,000 to myself. I'd rather do that. I'll turn it into office gym. So I don't know. Could be, yeah. I'm sure people don't want to create red flags with the IRS, but it would be legit. Credit score is 778. I was given the quote a 3.6 interest rate. Let me see if I can find the last one, Liz. Did you have a prior question, or is that vacation property? 3,625. That sounds a little bit high. I mean, hopefully the 3.625 sounds more like an investment property rate. But if you were buying something as how much down payment are you putting, Liz? I'm going to put in Liz Smith. I'm going to do a conventional loan. It's going to be a secondary residence, aka vacation prop, 778. Florida, their real estate's gone bonkers. So I'm going to call it a $500,000 purchase. And I'm going to say 20% down. I just want to get a quick purchase home. I think it's sub 3%. That's my guess. We'll see. Oh, 10%. 10% down. And you're paying MI or no MI? It's 3.625 might be. It's like if you're rolling in mortgage insurance. No way. The 20% down, I got 2.89. So 2.89 was no points. And then if you put 10% down, I got 2.96 with 112 a month in mortgage insurance. Oh yeah. Liz, you're talking to the wrong. What's the loan amount? Maybe if it's a small loan amount, it's more expensive. Because I'm getting sub 3%. So either you're talking to a lender that's expensive, or what it could be, I'll give some benefit of the doubt. If it's a really small loan amount, which I just saw that it's not, it's 270. Then then it could be more expensive because the small loan amounts lenders don't want. So let's see, remove that. Share, stop screen. Yeah, I'm getting 2.963 on that specific scenario. 778 credit score. I'm just showing exactly what we're working with over here. So nothing to hide. Here we go. Control, zoom it in. Secondary residence, 778. It's a 270 sales price, 10% down, so 243 loan amount. That's if you don't pay MI, like lender paid MI 3.317. But you said you're paying mortgage insurance, so here it is. It's 2.963. If we could zoom on that, baby, and $60 a month in mortgage insurance. Price zero, no points, 2.963. So if you're paying 3.625, holy guacamole. Bradley, this is United Wholesale Mortgage, where I send a lot of my business. The number one wholesale lender in the country. They do great work. They close loans quickly. I think my average is 19 to 22 days. And so this is just their pricing engine for this specific lender. Depending on if you work for a bank or a direct lender, you might have different pricing engines, but this one's for United Wholesale Mortgage. So yeah, that's a lot better than what you're looking at. Liz, you might want to get a second opinion. I mean, what's that gonna be difference wise? Like 3.625, 1108, 1019, $90 more per month. If you got $90 more per month and you like that mortgage professional that much, pay it. Or talk to a mortgage broker to help you out. Where do we go? Where do we go with that? This greatmortgagebroker.com. As somebody mentioned earlier, you fill out these 6 quick questions, connect with U Mortgage, who's licensed in Florida. They'll help you out. If they don't, they're in big trouble with me. And so go check them out. They're gonna be in that sub 3% range on that vacation home in Florida. So just saved you $90 a month, $1,000 a year. All right, Joseph, thanks for joining us. My understanding is that for a typical cash out refinance, the loan is for about 80% of the home's updated appraised value. Assuming that is correct, could you explain what happens with the other 20%? Does the homeowner simply retain that as equity in the home? Correct. That's exactly what happens. Is the lender, to not have too much risk, wants to have that 20% buffer. So let's say in your scenario, it's a $400,000 value. That's the appraised value. They're going to cap the loan amount at $320,000, 80% loan to value, just like you stated. So that other $80,000 is just retained equity that the homeowner has and that the lender requires in order to do the loan. The lender's not going to do a cash out refinance above that 80%. 15 years ago, you could do a cash out refinance to 100%. I mean, some lenders even went above 100%. And if let's say you have a $400,000 appraised value and you owe $360,000, you can do a rate and term where you're not taking cash out and you can refinance that and pay mortgage insurance, but you couldn't go cash out above 80% on your primary or above 75% on an investment property. Theo, what's up? You're right, man. I should trademark. If you like it, lock it. Man, why you always want to talk about the non-QM stuff, debt service coverage ratio loans? I made you a video. That wasn't enough. I'll talk about them for a minute because truth be told, these things are easy. And DSCR, what Theo is referring to here, and I'll do you a solid, man. I appreciate you support and I appreciate you being back. So I'll talk about debt service coverage ratio loans. These loans are loans for investors that don't have income that they can verify, like tax returns. Maybe they do something, that's a business that just doesn't show a lot of income on paper, has got a lot of legitimate write-offs, right? Or you're a real estate investor that just real estate is your thing, then that's what you do. You can qualify based on the debt service of the investment property. What is debt service? You've got a property that rents for $1,500 a month, and you've got a principal, interest, taxes, and insurance payment that's $1,280 a month on that property. That makes the debt service coverage ratio more than 1, because 1,500 rent is more than the 1,280 PITI. And generally, with just that and a good credit score and 20% down, that's literally all you need. Sure, you're going to provide a loan application and a credit report and all that other stuff, but really that's like the only criteria for it. And so those loans are popular in the investor space. They're going to be mid fours right now, probably. I don't know if I've done one in the last month or so, but I did quite a few earlier in the year. And, rates are slightly higher, fees are slightly higher. But for somebody who doesn't qualify for conventional, who's looking to get into investment properties, it's a great loan for that reason. And it's a great loan because if it doesn't pass that debt service coverage ratio test, then it's probably not a good investment, and you don't want to buy that property. And some lenders now, Theo, will even go above 1 to like 1.1 or 1.2. I don't advise, but anyhow, that's the basics of it. And I know I made the video where I went into some detail. I don't even remember them offhand what the certain caveats are on some of that stuff, but that's that debt service coverage ratio loans. LB Alexander, Credit Karma, says your scores are 780, 815. Generally, it's like a Zillow Zestimate, right? Where it's not, people will bag on Zillow estimates, but really, like, it's going to give you a general idea. It's not like the most terrible thing in the world. Sure, sometimes it's off and whatnot, but Credit Karma is the same. They're not lending you $500,000, so I wouldn't depend on it like it's the truth. But I would say if they're guesstimating 780 to 815, your mortgage credit score is going to be probably in that range, 750 plus. When a mortgage credit report is pulled, we pull Equifax, Experian, and TransUnion, all 3 of them, and we take the middle of those 3 scores. Now, if Credit Karma is showing you 780 to 815, it's likely you have near perfect credit, right? You don't have any blemishes on your credit. If for whatever reason you don't have a lot of credit, that might show negatively on a mortgage credit score. You don't have different trade lines. But I would guess that you'll be, 750 plus, which for a mortgage, you're going to get great terms. So I wouldn't sweat it. But Credit Karma doesn't necessarily mean that you're going to have a great credit score. I've had people that say my Credit Karma is 750 and their credit score comes back at 688. I've had people conversely say, oh, my Credit Karma says 705, and we pull their mortgage credit report and it's 762. So it really, it could be higher, it could be lower, it could be similar. But if it's that high, if your Credit Karma said 550, I'd be worried. If it says 780, 815, you're probably in good shape. Can I use an investment loan to buy a primary residence property? I have bad credit. Investment loan. I'm not sure what you mean by investment loan. To buy an investment property, the guidelines are stricter than primary, so you wouldn't want to do that. If you have bad credit, depends on how bad, primary residence FHA is going to be your best bet. They're the most flexible when it comes to credit score. And you can buy a primary with as little as 3.5% down. So blemished credit, challenged credit, whatever way you want to put it nicely, FHA is your best bet. And I was thinking about some of the things I'm going to put into the course as far as different loan programs for different credit scores and how it affects it. My blanket advice is going to be, if your credit score is less than 580, you shouldn't buy a house. You're just going to put yourself in a bad position of swimming upstream, where I would take care of the credit issues first, and then I would buy a house. I had a client who I talked to who had a $850 payment on a Camaro, because their credit was mid 500s. And this Camaro, they only owed like 22,000 on. If they had great credit, that payment would have been 400. They were paying double because their credit was terrible. And aside from that car probably being a bad investment because of the 22% financing on it, to a lesser extent, real estate would be the same. You would get yourself into a really ugly looking loan where it probably makes more sense. Work on your credit, get it fixed up within 6 months or 9 months or a year. You work that thing up to 640, 660. You're going to get yourself into a really good looking loan with really good terms. And I promise you, in 2022, there's going to be homes for sale. In 2023, there's going to be homes for sale. So I wouldn't be in a rush to buy a house if you're sub 580 credit score. Well, hello. I just thought of Lionel Richie when I saw that. Hello? I won't sing. My wife would tell me it's probably not a good idea. Probably lose subscribers real quick. What type of properties can you qualify for based on the property's cash flow? You're on the right track. 5 units plus, it's going to be based on the cash flow and the cash flow only. And, if you're buying a commercial property and commercial, multifamily is 5 units plus, they're going to look at the rent roll. They're going to look at the cash flow. And if the thing is a dog, they're going to require you to put a bigger down payment. That's something that I think people don't understand. And truth be told, like, I'm a residential guy, 1 to 4 units is all I lend on. So that's my area expertise. But I do know a little bit about commercial, and the little bit I do know, if you go and try to buy something that's let's just call it a 10 unit, and it's 30% vacant, 3 of them are vacant, and the units are renting for 600 when market rent is 900, and they're trying to sell it as if like, hey, you can get 900 per unit. This thing could generate $9,000 a month in cash flow. So we're going to sell it for this number. Well, when the bank looks at it and says, okay, you got 7 tenants paying 600, so that's $4,200 a month. It's half of the cash flow their pro forma or their, projections are showing you. They're going to require a big down payment if the price that they're trying to sell it for is based on $9,000 a month in income. Hopefully that made sense. Kind of lost myself there. Oh, Merrick Kozlowski. I see. Want to say thank you. I'm binge watching your vids. Let's see how long my kids let me stay on your live video. Kids like these. My kids like these. My kids are 8 and 12. They watch Matt the Mortgage Guy live. They get really excited when I get those. What are they called? Super chats. People can give you like $1.99 or $4.99. So yeah, I hope that your kids realize that you're investing in your future by educating yourself on mortgage, and that by doing that, you're going to secure your financial future, which in turn secures their financial future. So if they could see all the great generational wealth that's going to be coming their way, if you're watching more of these videos and educating yourself, then they'll allow you to stay on the live video. So thanks for watching. All right. Sarn L. I'm in the process of learning my market. Should I wait until I'm ready to purchase before checking how much I'm pre-approved for? I think that, well, if you came to me, I've had this conversation 100 times. So I can tell you that it definitely does not hurt to go through the pre-approval process. And let's say you called me today and said, hey, Matt, I'm looking in Sacramento. I don't know if I should get pre-approved though, because I might not buy until next year. I'm just trying to learn the market and figure out this. I think it's a good idea to get pre-approved because of what you learn through that pre-approval process. You're only going to spend a little bit of time and energy filling out an application, sending me and my team supporting docs. On our end, I've got support staff that I'm paying. We're going to spend our time, energy, resources. I'm going to pay to get your credit pulled, whether you close a loan or not. That's sunk cost for me, that $31. And so I'm happy to do that, because then I get to show you, hey, Sarn, I know you're looking in Sacramento between $350 and $450. Here's what it looked like if you put down 20% at 350, 400, and 450. Here's what it would look like at 25% at those prices. You're qualified. You're good up to about 500,000. But I know you're targeting these price points. Principal, interest, tax, and insurance. There's the total payment. There's the total cash to close. I'm going to give you all that information. I'm going to give you Excel spreadsheets that you can adjust the price. So you can see what it would look like if you bought for 410. All that information that you're going to glean from that pre-approval is going to help you start like narrowing down your search, right? Because you might just be looking and you don't even like have a firm grasp on what the payment's going to be, but you're like, okay, if I buy in SAC something about 450, I think that in this neighborhood that's going to rent at about, I don't know, $2,200 a month, you're kind of guessing at like how that thing's going to pencil as an investment. Once you get pre-approved, I'm going to show you based on your credit score and your down payment and the price points, exactly what the loan's going to look like. You want that information. You want that information to go out there and be an informed investor who's looking at, those things. And I just thought about it in my head. You might not be an investor. You might just be buying a primary residence, but same thing stands. You might be thinking based on some like Zillow number or just a guesstimate in your head, here's the price point I'm targeting. When I show you 400, 450, and you go, oh, you know what? I thought I was going to buy at 400, but the payment at 450 is only this much more. And for $200 more per month, I'd rather live in that neighborhood with those schools with that. And that's an affordable payment, right? All that stuff is just literally free information, free education for you to make a better decision. I'm so pro people doing that I don't care if you ever buy a house. I don't care if you don't use me and you use somebody else. Do that. And I'm happy to have my team spend time, effort, and energy. We're at a point where I'm blessed to be as busy as I am, that if somebody gets pre-approved, gets all that information and is well prepared and then goes out and submits an offer and gets something accepted, I'm not like hunting people down. Like, you better be using me and my team. But do that with somebody, right? I saw that you did follow up with, you are learning for investment, which it's even more important in my opinion as an investment, because you're going to want to analyze those numbers and look at returns and all that other stuff. Just sign your closing docs today. What's next? The lender should be funding and recording. If it's a purchase, within a day. If it's a refinance, then you've got those 3 days, that are your right of rescission where you can cancel. Then it's going to fund and record. So if it's a refinance, it's going to fund and record Friday. If it's a purchase, it's probably tomorrow. If you've already wired your funds to title, then you should be all set on your end. This is a bunch of information that I would think was given to you beforehand from whoever you're working with. But funding and recording shortly on a purchase, within a few days on a refinance. If there's cash due from you at close, that should be either already in title or wired to title very shortly. Check in with whoever you're working with. They should give you that information. If it's us, then hopefully we didn't drop the ball on giving you the information in advance. Before I talk too much smack about the lender, I was going to verify it wasn't us. Paying PMI. Oh, that was from earlier. Yeah, Liz, you gotta price check that second home in Florida, because I think you can do a lot better. If my husband is the only one that's going to be on the mortgage, what would happen if the closing cost funds will come from my bank account? The money is seasoned. If you guys are married, it's good. Good to go. Yeah, that's no problem. Likely, depending on what state you're in California, it's a community property state. Like, you're likely going to be on title, even though he's the only one in the mortgage. So, coming from your account is going to be not a problem at all. Maybe the lender wants a letter of explanation that's the wifey, right? Yep, same question. Yeah, you're right, Liz. That is a big difference. 2.8 something or 2.9. And there you go, Theo. Side note, keep buying UWM stock. That's the lender that I show. That's who I price with. They did 182 billion in volume last year, the biggest wholesale lender in the country. They pay about a 5% dividend too, Theo. So that doesn't hurt. I think I got a last dividend a couple months ago. They got another one coming in July. So it's a nice little perk of owning their stock. Great company. I sit on their advisory council. I'm going to be back out in Pontiac, Michigan in July with 15 other brokers from across the country, giving them advice on how they can continue to improve their platform for mortgage brokers like myself. They're already the best, and they just continue to get better. So I'm pretty bullish on UWMC, and so I think you're in good shape there. The other one I like is Endeavor, who bought the UFC. If anybody's a UFC fan, Endeavor stock, I think will do well in the future. This isn't a stock channel. I'm just some guy on YouTube. I'm a mortgage broker, but since you went there, Theo, I went there. I think the modifications are happening when you exit forbearance. That's the most common thing I'm seeing. So, some people are exiting forbearance. A lot of people are exiting forbearance in these next 3 months. So we'll see. All the stories I've heard is client calling servicer saying, "Hey, I'm exiting forbearance in 3 weeks. What do you got? What do you got? Let's do it." So, yeah, give me any feedback or anything that you hear about that. I'd love to know what people's real life experiences are with exiting forbearance, what servicers are doing, and what kind of terms they're offering. LB Alexander, great point. Smash the like button. For Matt, for the YouTube algorithm, for whatever. We got 23 likes, the last I saw here, and 46 watching. So we're batting about 500. You guys are doing all right. But we can get it up to 40, I think. You guys keep working on that. Look at ding, ding. I see it dinging. All right. Janice, another fan of United Wholesale Mortgage, cash out refinance. I mean, they're really the best. For mortgage brokers like myself, they're the best. I work with Home Point. They're great. I work with N2. I work with, what else do I work with? Remnant. I mean, I work with Caliber. I work with a bunch of different lenders. UWM is by far the number one wholesale lender in the country. I mean, that's why they're head and shoulders above everyone else. Technology, speed, pricing, service, all that good stuff. They do so much that people will reach out to me and say, "Hey, they've got some negative reviews." And I'm like, "Sure, if you do enough business, you're going to have negative reviews. And you probably have more negative reviews than anybody else because you do 10x, 50x, 100x. Some of these smaller lenders are doing $2 billion a year. UWM's doing 180, doing 90 times more business. You think you're going to have more people that are upset because, the refund check from servicing took 28 days instead of 21? For sure. Garasi, what's up, brother? Good to see you. Jeracy? Joey G is back for some knowledge. Good to see you, man. Good to see you. Glad to have you here. Answer this one real quick before I give it back to my buddy Joey. Are you seeing more VA loans offers being accepted by sellers? I'm seeing, just in general, this is the word, normalizing. The market is normalizing. Everyone's just going to take a deep breath. A little bit more inventory is coming on. I just recorded a video that's going to come out tomorrow. The local markets that the real estate agents I'm working with are tracking 8 straight weeks of inventory increasing. We are slowing down. We're not in a slow market, but we are slowing down. What was the stat I was looking at? Multiple offers in April. It was over 75% of homes got multiple offers. In May, it was 70%. In June, it was less than 70%. Over the last 3 years, it's fluctuated between 40 and 55%. Because we've been in a seller's market for years. I mean, there's been a lack of inventory for years. So it's fluctuated between 40 and 55. It's went up crazy over these last, 6 to 12 months. It's been wild, but it's slowly normalizing is the word I'm using to describe the current market, which means VA stuff is going to start getting accepted more. FHA is going to start getting accepted a little bit more. Not every single one of them, right? But a little bit more. If it used to be 5 or 6%, maybe it's 8. If it used to be 10% of loans were FHA, maybe it's 12. Another function of that is conventional loans are just really good right now. Conventional loans, for the vast majority of people, 680 credit score plus is just a better loan. If you're 640 to 680, FHA might make sense. But in the market we're in, some people have opted to go conventional at 660 credit score, even if the loan was slightly worse, because they had a better chance of getting accepted. At least in their eyes, their lender's eyes, their agent's eyes, maybe. And so they put that together like that. But VA loans, the cool part about this, because everybody loves veterans and everybody wants to see VA loans get accepted. When I looked at the numbers, because the VA loan's only available to a small percentage of folks who are eligible, the numbers are never going to be that 20% of sales go to VA. But historically, whatever the number was versus the number we saw in the last 12 months wasn't that far off. And so VA offers were getting accepted, albeit I'm sure that some got passed on and some missed out because of the craziness of the market, because some of the conventional buyers that could offer $150,000 above ask. But I think to answer your question, we are going to be seeing more offers of all types being accepted by sellers because we just have more inventory. We have a little bit more stuff that's going to cause it to be easier. We're shifting in that direction. We're still a seller's market. We're going to continue to be in a seller's market for the foreseeable future. It's just going to not be as strong of a seller's market, in my humble opinion. All right. Meeting with a B of A loan officer tomorrow. Will you let me know anything about anything new that I learned? Oh, we'll let you know. Yeah, let me know, because was that the one? Was that the grant? Or this is their down payment assistance plus closing cost assistance program? Yeah, let me know. I forgot what state you're in, but if it's a nationwide program, it'd be really cool for you to let me know. Then I could even maybe make a video on it. Down payment assistance programs are tough because they're hard to get accepted in a market like this. And then the state programs, they're different in every single state. So I can't really speak to them like on a general sense. But what I do know about down payment assistance is I don't like what I've seen based on my mathematical mind. And the only thing I've been able to equate it to is a payday loan. If your transmission went out and you had to pay $1,200 to get your car back on the road and you needed it for work, if it was an emergency, you had no other way to go about it, and you went to a payday loan and you borrowed $1,200 and you paid them back $80 a week for a year, and so you paid them back $4,000 on that $1,200 loan, that'd be some shitty terms. But if it was the only thing available, I guess you had to do it. If you could borrow $1,200 from a relative, you could even offer to pay them back $1,500. You'd be $2,500 better than that payday loan, right? Unfortunately, a lot of down payment assistance programs I see are like that. High fees, a second and a third. And not only do you get in a position where you're paying a higher interest rate and you're paying higher fees, even worse off for some people is all the people I've talked to in the last 6 or 12 months that can't refinance out of it. Rates are super low. And I'm like, man, if you didn't have the second and third attached to your loan, I'd be able to get you into 2.8% interest rate and you'd save $400 a month. But you're stuck in that first because you have a second and a third. And there's, even with the market appreciating as much as it is, it hasn't appreciated enough to be able to wrap all those loans in there, do a cash out refinance and pay them off. It can get nasty. All right. I refinanced my place in February. Do I have to stay here another 12 months according to the occupancy statement? I've owned the property for 3 years. Here's my unofficial answer. Off the record, except for that it's recorded live on YouTube. You intended to occupy the property for 12 months when you signed your loan documents. If something changed and you decided that you're going to move closer to your job, closer to grandma and grandpa, whatever the case may be, life happens, things change. If you move 5 months after refinancing, the FBI is not at your front door. You're not going to be, held at gunpoint from the FBI. You'll be fine. I just wouldn't necessarily refinance primary, then go buy a new primary 2 months later. It can look like occupancy fraud. It could look bad. And lenders on your purchase forward might look at that and go like, you just refinanced this primary. But I think you'd be fine if you bought something else down the road. If you sold that house, you're totally fine. But if you're going to keep it as an investment and now move into something new, then it's, a little bit gray area-ish, right? How can my phone be muted and it's still ringing? Oh, it's the watch. Excuse me. I thought I might have only muted things for an hour. All right, mute for another hour. I'm going to go about an hour and a half tonight. We got a lot of good questions. We're doing some good things here. I like the vibe. Hopefully we're adding some value. But yeah, hour and a half is about all I got in me today. All right, Scott Wang, good to see you back, my man. Thanks for joining. If I want to do a refi, do I have to wait 3 months after resuming mortgage forbearance? I'm guessing that you basically are saying after you come out of forbearance, which this used to be the case back in 2020 when forbearance was a brand new thing. I can promise you that 95% of lenders I'm working with, the minute you go out of forbearance, you can refinance. This 3 month waiting period is virtually non-existent now. Maybe there's a handful of lenders that still do it this way, but all the lenders I work with, all the lenders I send business to, once you're out of forbearance, you're good to go. You can refinance as long as you qualify. I skip my buddy Baby Sharker. My apologies. Go use my FICO for 1 month and get your 245 scores. That will answer it. All right. That was in response to somebody, I think, asking about their credit score and their credit karma. If you want to do this, I mean, people are so afraid to get their mortgage credit report pulled. And I really don't know why. I probably have to make a video just letting people know it's not really going to affect your credit that bad. I mean, I recently did a loan and I've got more than 12 inquiries in the last 12 months. And more accounts opened than, is good in the credit bureau's eyes. And my credit score is still 790. So I'm not a big believer in like mortgage credit pulls or credit pulls in general hurting your credit score, unless you're doing 4 a month, one at Best Buy, one at the car dealership, one with the mortgage broker, one at the car, boat dealership. I don't know. Multiple pulls from multiple different places in a short period of time. Yeah, it can hurt you, but just one mortgage credit pull, not going to hurt you that bad. 0 credit score, solid work history and on-time rent, utility payments. What kind of increase on the base interest rate should I expect? Probably. And this is where Dave Ramsey, apology in advance, like he just gets it wrong. This whole like, oh, you don't have a credit score. It's the best thing in the world. You can get manually underwritten. What they're going to do is they're going to use a 580 credit score to base your rate, right? Because they have to use something. And oh yeah, they'll manually underwrite you. You don't need a credit score. You can still get a loan, right? But you're going to get it the same as you would as if your credit was horrendous. And so 1 to 1.5% is probably what you should expect. And you should expect just a harder loan process. For whatever reason that there's no credit score, hopefully it's a good one where it's like, I got all my debt paid off and I don't owe anybody anything. Great. But if that means that you're paying an extra $4,000 a year in interest or $6,000 a year in interest on your mortgage, That's a big price to pay for no credit score. If there's any way to get a credit score to populate, I'd probably do it. I mean, I know a lot of people that use credit responsibly, never pay a dime in interest, and have perfect credit scores. If you're responsible enough to pay it all off to where there's nothing showing on your credit, you got zero credit score, I think you're responsible enough to have 2 or 3 open trade lines where you charge, pay off in full, and don't ever pay a dime in interest, but have a good credit score to save yourself a ton of money on your mortgage. When can PMI be eliminated? It can be eliminated if you've got a current conventional loan. A lot of lenders, their thing says 78% is the magic number, right? And so if you owed $400,000, I'm sorry, you bought for $400,000 and you had a loan for $380,000, right? You're going to have to get to $400,000 times 78 in your amortization schedule, $312,000 loan before it will automatically fall off. Or you refinance and you're at 80% loan to value and it gets taken off, which, that scenario is more likely nowadays. One, because home prices have appreciated a ton, and two, because rates are lower. So it would make sense to refinance, right? It would make sense for you to, why does my screen keep getting dark? It's so weird. It would make sense for you to go in there and say, oh, my home is now worth $450,000. I owe $342,000. I've got enough equity to remove mortgage insurance. While I'm at it, I'm going to go from a 3.5% down to a 2.875. A lot of hand gestures tonight. I don't know what that's about, but it's really crushing it with the hand gestures. Sure, you've heard this question many times, but if I don't find a house within 90 days, will it hurt my credit score to get pre-approved for another 90 days? Not necessarily. I mean, it's the same thing as the prior thing where I just talked about. If you pulled your credit 4 times in 1 year, every 90 days with a mortgage lender and nothing else, it literally does a trailing 12 months, your credit score of how many credit pulls you have. And that's what helps or hurts your credit score. Mine shows more than 12 in the last 12 months, and it doesn't do enough damage to me to pull me below 790. Maybe I'd be 810 if I didn't have 12. But, you might have 7 pulls in the last 12 months, and then 3 months later, you get a mortgage credit pull. If a couple of those credit pulls were 10 and 11 months old, now your last trailing 12 months is 6 credit pulls. And so you're going to be fine. So long-winded way of saying you'll be fine. What is a great TDI for front end and back end? I mean, great is friggin' 4. But for qualifying purposes, you want your front end to be lower than 36, and you want your back end to be lower than 43. Anybody who's unclear on front end and back end debt to income ratios, the front end is your payment on your mortgage versus your income. So if you've got a $3,600 mortgage payment and $10,000 in income, that's a 36% debt to income ratio on the front end. If you've got $700 in payments between your student loans and your car loan, then the mortgage plus those payments is $4,300 versus that $10,000 income. That's 43% as a back end ratio. Front end, just your mortgage. Back end, mortgage plus debts. Your question, Baby Sharker, is how do you figure an equivalent front end for comparison purposes? Are you comparing it for your own knowledge, or are you comparing it for the lender? Because what the lender will do with certain non-taxable income is they'll quote unquote gross it up. They'll take it and they'll say, oh, you've got $5,000, but it's non-taxable. So we're going to gross it up 15%. We're going to take that 5,000 times it times 1.15. I just messed up, times 1.15. We're going to call your income 5,750 because you don't pay taxes on it. And so then you just take the 5,750 and you take the ratios. But I mean, as a consumer, my thought is you go to a broker or you go to a lender and you say, listen, what do I qualify for? Or better yet, you say, I'm targeting a $400,000 purchase price, and you go through the pre-approval process. You might ask them what your DTI is. You might ask them, like, is there some wiggle room in that? Do I qualify for more? What I love to hear is somebody saying, this is a payment I'm comfortable with. And I go, okay, cool. You could qualify for 600, but you're definitely qualified for the $400,000. I'll show you 375, 400, and 425. You want to keep it in that range, right? Because I don't generally see great things happening when somebody is like, what's the very max I qualify for? And they're trying to just like hit that right on the head. Like, I want to do the very, very max. It's a bad thing to do. YouTube rules. What's up? Good to see you back. How soon after closing can I move into a home? If you bought a house and you don't have anything worked out where you're going to rent back to the seller, you're going to close your home. You're going to get the keys from your realtor once you fund and record, and then you're going to walk to your house and you're going to open the front door. You're going to call your friends, tell them you're moving. They're going to say they're busy. Then you're going to load up a U-Haul on your own. You're going to move into your new house. But you should get them as soon as you close. Closing is you signed your final loan documents. The title or escrow, this is California I'm speaking about. It might work different with attorneys in other states, but they're going to request the funds from the lender. The lender's going to fund. They're going to record that new deed with the county. And so it's going to be funded and recorded, meaning it's officially recorded in your name. It's now your house. You get the keys from the realtor, and the realtor says, congratulations, you're now a homeowner. And then you go move into your new house. Congrats. Chief Woodenhead, how you doing? How much do I need for an investment property down? I'm in California. Credit is 800. My primary residence is estimated at 390, and I owe 315 on it. What are some options? Thanks. You are the man. I appreciate the kind words. What I am guessing you are alluding to it by sharing the information about your primary is maybe you're thinking about taking some money from the primary. Maybe not. Maybe you just threw that in there just for S&Gs. But investment property, you could do 15% down if it's single family. The terms are not going to be so great. You could do 20% down. The terms are going to be better. The best terms or the best bang for the buck, and me and Mike Zuber last week actually went through a little, what's it called? We ran scenarios for cash on cash returns, and 25% is the magic number for investors. That's where you're going to get the best rate, best bang for your buck. 25% is the magic number. 15% is the minimum on an investment property purchase. Can I get pre-approved with no credit pull? I know my credit score. Depends on who you call. If you call me and my team, we are probably going to tell you to go fly a kite. In a market that's as competitive as this one, there's no real reason to not want to do a full pre-approval, which means full application, pull your credit, upload all your docs, order verification of employment if needed, really scrub it so that we can let your realtor know you've got access to pre-approval letters. Cayo West is well qualified. We've got his credit pulled. We've got his verification of employment in. We know exactly what we can use for income. We've got verified assets in the bank. I'm happy to call the listing agent, because if you got pre-approved with not pulling your credit, who knows what could be on there, right? There could be something on there that you don't even know about that's affecting your credit. And so the difference between 712 and 740 might be 1/8% on rate. That's going to affect how much you qualify for. If you have some crazy judgment on there that you didn't know about, that could affect you qualifying at all. And the last thing I'm going to do after busting my tail for 7 years to have a really good reputation with every real estate agent that I've ever transacted with is call a listing agent and go, yeah, we've got him pre-approved. He is ready to roll. Have you get in a contract, have it explode, and then say, oh yeah, we didn't pull his credit. Then we found out once we were in contract that there was a judgment and there was, some, I'm not even going to speculate, right? But something, right? Something could come up. So short answer, no. I was laid off 4 months ago. Sorry to hear that, man. I have my mortgage paid until 2022. That's good. Should I be looking into forbearance in case I do not get a job? did you prepay your mortgage? Because I would say if I was you, there's not really any negative repercussions from forbearance. If I was in your position, I'd probably, man, if it's prepaid, or like, here's the best case scenario in my opinion. If you mean I have my mortgage paid like you have reserves in the bank, keep those reserves in the bank. Go get into a forbearance program. I mean, because you're the person that needs it, right? People that are still working are going into forbearance. The servicers aren't requiring people to really prove anything. So it's like, oh, I went from 40 hours a week to 38 and a half. I'm going to go into forbearance. You being laid off, I think, are a perfect candidate for enter into forbearance and get the work stuff figured out. Don't have the stress of the mortgage payment. Even if you have those payments in savings, which I'm hoping is the case when you say paid until 2022, keep that buffer in savings. If you find a job 2 weeks from now and you want to come out of forbearance, you can do that. If you don't find a job for 6 months, then when that 6 months is over, let's say you find a job and then you exit forbearance and you can start paying your mortgage again, you're going to have options when you exit forbearance. You can put that balance on the back of the loan. You can take your savings that you had, if you want to throw it at that and have it paid off and just not worry about it, you can do that. But I would definitely look into forbearance. Just take advantage of the programs that are out there for people that need it, right? You're somebody who is in a position where it's going to be helpful. I get upset when I hear people that just take it for the fun of it. And I can tell you that I know investors that are in such great financial position that took forbearance on 20 properties and didn't pay their mortgage for 12 months. And that 12 months times 20 properties turned into an extra $250,000 in the bank. That is a little bit gray area when it comes to the wrong or the right thing, right? In your position, take it. My opinion. Does my earnest money go to the title closing lawyer? Lawyers are what is used in many states. Here in California, it's an escrow company, title company that holds your earnest money, and you send that earnest money into them. It gets applied towards your total down payment plus closing costs at the end, and then you wire in the remainder towards the end of the transaction. But I'm thinking earnest money likely if you're in a state that's not California, that I honestly don't do business in and I'm not an expert in. Similar type thing where you send your earnest money, cashier's check or wire to title closing lawyer. All right, Sarn, good stuff. Get yourself pre-approved. Get out there and start home shopping. When do you start paying the mortgage after closing? If you close on the 10th of next month, we'll call that August 10th, then you're not going to pay until October 1st. It always is not the preceding month is preceding next, but the month after. English, not my thing. Math, I crush. So whatever you call the month after next month is when you pay your mortgage payment for the first one. And I did make a video somewhere on my channel about it, but in your case, you close on August 10th, no payment on September 1st, first payment October 1st. If you close in September, first payment November 1st. Close in October, first payment December 1st, and so on and so on and so on. Caden, is there a way for consumers to find out their mortgage credit score? I've noticed it's quite different from Credit Karma and other common sites. You're involved in a mortgage process, so they pulled your credit. Ask them. They'll let you know. I don't know if there's really any way to get a mortgage credit score other than doing a mortgage transaction. But here we got Maria. Maria, my CPA. Use my FICO, and you can see what your FICO score, as long as your mortgage score, auto score, etc. All right, my FICO. There we go. Thanks, Maria. That's why I got all the smart people in the comments. It's my backup. Is the W-2 income from the C Corp I own make me self-employed or a regular buyer? You are self-employed. We can use a combination of the W-2 income and the C Corp income, which is what we'll do. If you've W-2'd yourself for a number of years, then we can use that income along with your C Corp income. For all my S Corp borrowers, we've got what shows up on their K1 plus W-2s, because a lot of people, right, they W-2 themselves, and then they've got pass-through income through the corporation. So combination of the both, but you're definitely self-employed. In June, I refinanced out of my FHA loan into a conventional loan. My question is, how long do I have to wait before we qualify for another FHA loan? Love the channel. Thank you, sir, for the kind words. I appreciate it. Why would you want another FHA loan? If you refinance into conventional, my guess is that your credit score is decent. And FHA is really for first-time buyers, challenge credit, low barrier to entry when it comes to how great your credit has to be, and low barrier to entry on your down payment because it's only 3.5%. If you're buying a new primary, you can go out and buy a new primary with 5% down. If you're where I see this, because I work with so many investors, is that they want to go out and buy a triplex or a fourplex that they're going to own or occupy, right? So if you just refinance into a conventional loan, your intent was to stay in this house for 12 months since you did it as a primary residence. Depending on your plans, maybe next year you want to buy a 3 or 4 unit FHA and own or occupy it. But if your credit's 680 plus, 700 plus, and you're just going to go buy a new primary, I would go conventional. If it's because you want to do some sort of house hack and the FHA is the lowest down payment and do it that way, then do it next year in 2022. Go buy a quad with 3.5% down FHA and start adding some units. I've been approved by B of A using their down payment assistance program with a rate of 2.875. It's a pretty good rate. I mean, the thing is going to be, how long does it take to close that loan? And can you write an offer in your market with that 45-day close, with that 60-day close, and get it accepted? Also, what are the fees associated with it? And what are the terms? You got to stay in that loan a certain amount of time before the down payment assistance gets forgiven. Do you have like a silent second where you pay back that down payment assistance? Is it a true grant where you don't pay it back at all? A lot of questions that you need to ask when you're using down payment assistance, because I'm telling you, I've talked to so many borrowers who are like, I don't know, I just knew that I only had to bring $1,200 to close. And I'm like, oh, you owe a $12,000 second and an $8,000 third, and this one's collecting interest. Lucky the third's not, but you've got $20,000 sitting on the back of your first where you essentially can't refinance. So you're stuck in that first. I mean, there can be layers to it where you just want to know. You don't want to just sign your life away and like 2.875 first. All good. Here we go. Can lenders extend the rate lock? Faux show. Most of them should be able to extend it for 30 days at very minimal cost, depending on if it was a you thing or a them thing. I would tell them, propose at least, can you pay for the rate lock extension, depending on how much longer you're going to need? Maybe it was an appraisal delay. Maybe it was something on their end. Maybe you were a slacker. Maybe you drug your feet and didn't provide them the documents fast enough. In that case, maybe that rate lock extension's on you. But either way, it shouldn't be very expensive. On loans I'm working on, we could extend them for 30 days for 10 basis points. So if it's a $300,000 loan, I can extend it for 30 days for $300. So not very expensive. Is having a HELOC that's zero balance a hindrance to cash out refinance? I have excellent credit, LTV. It can be, and here's the answer. I literally had this happen on a loan of mine today. 126 is the balance, right? You want 150 cash out, so there's 276. If you didn't have that home equity line of credit, your loan to value is 50%, right? And the pricing on that is great. But let's say that you have a home equity line of credit that's open with a $150,000 line. We have to use that in the combined loan to value. So now it's only a $276,000 cash out refi, but when we add that 150 to it, now it becomes a $426,000 $426,000 combined loan to value versus the 600. What's that? That's 71%. That pricing is going to be worse than it would be were that not to exist. Still, you should get really good pricing at 72% loan to value. Not as good as you would at 50% loan to value, but still pretty good. But that's the only issue. Yeah, on a 15-year cash out with those parameters, you should be smoking. You should be low twos. But like I said, it's going to be slightly worse because of the combined loan to value. The whole line, whatever's available on the line, is going to be factored into your combined loan to value. Building new construction, closing approximately October-ish. Where's the second half of this? Uh-oh. He said that they will just apply that. Oh, there we go. I kept scrolling down. It was like 2 things down. Towards closing costs. Does that make sense? It sort of seems like it won't really cost us anything extra in the long term. Oh, just applying it towards closing costs. Offered for us to pay to lock the rate for longer than the typical. Yeah, I mean, the longer rate lock is going to cost you more. If he's like, oh, no, it just rolls into your closing costs. I mean, it's still a cost. That's like, oh yeah, it'll be a line item on there. Like, don't mind that $2,200. You're just paying it. It sounds to me, I mean, I would look at it. I would look at how much is it costing. What month are we in? July? So that's like a 90-day lock. Look at how much it's going to cost. And by your verbiage, it's like they'll just apply that towards closing costs. I mean, closing costs are covered by you. You're paying it. It sort of seems like it won't really cost us anything extra. I think it does. I think it is being applied to closing costs and you're paying closing costs. If they're applying a credit and covering it, then that's cool. Why would a person not buy a home, go into forbearance before September, then come out in a year and request a 40-year? Some lenders are poo-pooing people like buying a new home, then going immediately into forbearance. I think you might be signing something that you qualify for a mortgage. You're in a good position where you shouldn't be immediately entering forbearance. But I mean, it's a little bit of truth to your comment about like, why wouldn't somebody enter into forbearance just to be able to get into a good looking loan mod, except for that, like anybody who's trying to do future stuff when it comes to investing in real estate or whatnot, like a loan modification isn't necessarily something you want to do unless it's needed. Not saying it will affect your credit, but it can. Not saying it's going to hinder you buying investment property, but it can. And so, the forbearance, exiting forbearance, having options for 40-year loans is something that should only be taken by the people that truly need it. Thank you for answering with kindness. That's nice. It's nice that I answer with kindness. What was the question? Manage with 10% down, then refi as the score develops. Man, is my memory that bad? Oh, 0 credit score. Yeah, I mean, I tried to not bash Ramsey, but gosh, it frustrates me because it's really, really detrimental when you're getting a mortgage to have no credit score. Yeah, go 10% down. And if you're in that higher interest rate for 9 months, not that big of a deal, but you could have the mortgage be one of the lines that's going to help populate a credit score. And then maybe one other line, $1,000 at your local credit union. If you're debt adverse and you don't want debt, which I understand certain people do, then just $1,000 and, you charge $200 on it. a certain portion of what your monthly spend normally is, and then you just pay it off so you're not paying interest. And within 6 to 9 months, when your score populates, you're going to be in a position to refinance and get into a lot better looking loan. So yeah, cheers to you, and best of luck to you. What is real estate? I have a disability. Understanding things is hard. Real estate is like homes. It's funny that like it seems like a simple question, and then I'm having trouble answering it. But yeah, basically real estate is property. It's another way to say property. If you qualify for a VA loan, it's no PMI. Correct. A refi would start the amortization schedule again, but here's the trick. You can refinance into any term you want. Most lenders I work with, I can refinance you into a 27-year loan, a 22-year loan, a 19-year loan, a 13-year loan. So if starting over the amortization schedule is something that you're opposed to, then just refinance into whatever term you have left. If you've paid on it for 3.5 years and you're, 26.5 years from getting paid off, let's put you in a lower rate. Let's go to 26 years. You'll shave 6 months off your loan and go into a lower payment. What would your first 100 days of an LO look like if you had to start over again? 100 days of telling 1,000 people that I do mortgage. And I wouldn't do it in a way that came across as salesy. I would do it in a way that came across as, here's something exciting that I learned today. Did you know that you could use gift funds from a relative to buy a house? That's cool. And that goes out to 100 Facebook friends. And then the next day it's like, I learned something real cool today, that if you want to buy a house from your mom, you could do a gift of equity purchase, and then explain how that works. And by sharing mortgage information, stuff that's valuable to people, you're not just asking for business, you're sharing information and adding value. It works in many ways to benefit you. One, you're learning as you're doing it. Two, you're like telling people, I do mortgage. And I think that that's like what I would do even more of. I did some of it. I started the YouTube channel fairly early, just putting out content, and I did 1 video per week. I'd probably do 2 or 3 a week, and I try to like shorten that learning curve, learn as much as I could, because if you're going to put something out there, whether it's an email blast, whether it's a Facebook post, whether it's Instagram, whatever it is, you're going to want to learn a little bit about it before you do it, because you don't want to put out information that's not true or inaccurate or garbage. So you're going to research it for 30 minutes. It's going to make you smarter. It's also going to let anybody who knows, that sees it, that you're in mortgage, you're excited about mortgage, you're excited to help people. And, people enjoy stories. Last night, I was sitting at a little local pool. It's like a cabana club in my neighborhood. And I was talking to a neighbor of mine. I told her a story about a couple different clients I've worked with, and both of us were crying. And I was just sharing with her how much I enjoy helping people out. Having a veteran who's 57 years old, who never thought he's going to buy a house, crying at the closing table. Like, that's important work. And I was sharing the story human to human because it came up in conversation. But that's the kind of stuff where, you're letting somebody know the profession you're in without, just putting up a sign that says, I do refinance, call me, and so that's what I think you do as an LO. You do as much as you can to spread the word that you're doing mortgage, and you do as much as you can to improve your skills by learning as much as you can about how to serve people at a high level. All right, conventional loan. when there's all the responses from the stuff up here, I've got like some serious fog brain from just working too many hours, where I'm like, what did that one tie to? Dominic, thanks for joining. Bought my home in July of 2017 for $305. My current principal balance is $91K. What have you been doing? Just paying like crazy on that thing? Whatever you're doing, that's good. It depends on your goals. My first thought is like a loan balance that small. It's really, the smaller your loan, the more or the less beneficial refinance is. Because let's do some quick math and just say 91,000 at 3.875 and we lower it to 2.875. 1% of 91,000 is $900 a year. If there's $3,000 in loan costs and you're saving $900 a year, yeah, you're going to pay for it within, 3.3 years or whatever that math turns out to be. But, if that was a $400,000 loan and you're saving $4,000 a year, that loan pays for itself in under a year. And that's when it's like a super, easy decision. Yeah, that thing makes sense. The only thing I would probably look at is if you're aggressively paying it off and that's your thing, is like, I want to have this thing paid off as soon as possible. Maybe look at a 10-year. You might be able to get a 10-year in the low twos, 2.125 or something. And then you're helping accelerate that pay down that you're already likely paying extra on. But it's not a real clear, you got to refi. If you tell me to, like, Matt, I'm paying $3,000 a month to get this thing paid off as soon as possible, and you're doing something to have it down to 91,000, then my answer is probably going to be just continue to do what you're doing. Don't refinance. Sub 100K loan amounts, I'm not always, I'm rarely advising a refinance. Under 125, most lenders make it the pricing worse. They don't want it. And I'm not saying lenders like me, I'm talking about the lenders I'm sending the loan to. They just, one way of turning away business is making the pricing worse. And they're just basically saying sub 125, no, thank you. My dude, Mark McDonough, Sacramento Real Estate. I'm glad you're catching me live. I hope you're still on here. You probably made this comment 10 minutes ago. I'm going through these as fast as I can, but yeah. All things Sacramento, dude. I can't believe how much content you put out, Sacramento and surrounding. I saw some stats today about Sacramento, and I forget sometimes nationally how amazing of a market Sacramento is, and it's not just because we got influx in the Bay Area. Sacramento is just an attractive place to live for lots of people for lots of reasons. And Mark McDonough is the very best at showcasing, Sacramento, Elk Grove, Granite Bay, Roseville, El Dorado Hills, all the surrounding Northern California markets that really surround Sacramento. Mark's doing home tours. He's doing, neighborhood reviews, all kinds of stuff. Keep up the good work, dude. I got to join you on a Wednesday. You got to have me on, bro. I'm ready. Let's do it. Mark does lives way more than I do, for sure, every Wednesday. And I know he trickles in a couple others during the week on top of all the Sacramento stuff that he's doing. So, man, I thought I was busy with videos on YouTube, but Mark's next level. 220 earned 240K net. This year filed taxes and earned 465 net. How will they calculate my income being self-employed? They're more than likely going to take an average. Here's the thing. How long have you been self-employed? Because if you were a borrower of mine, and depending on what you want to qualify for, let's say that we take a 2-year average, and your 2-year average is 30 grand a month. That's roughly what it's going to be, right? It's going to be about 360 a year. You're probably going to qualify for more than you want or need. I don't know, depending on the mansion you're trying to buy or the 7th rental property, whatever it is, right? You're probably going to qualify where it's going to be a non-issue. But if for whatever reason, if you've got 8 rental properties that are negative on your tax returns and you're trying to buy number 9, so it matters, like we need to show $37,000 a month in income. If you've been self-employed for more than 5 years and we can, prove it, CPA letter or something, we can use just the last year of tax returns. So that's what we would do. We would set up and structure the file, more than 5 years self-employed. We'd run LPA, loan prospector, and more than likely it's going to just require 1 year tax returns. We're just going to show them 220. I think you might have been saying 2019. You filed in 240. Because this year you're talking, you filed already, right? So the filed ones, 465, I'm guessing is 20. The 240, I'm guessing is 19. But if we can use just that 1 year of 465, then we'll do it. But like I initially said, it's probably going to be a moot point, right? It's probably going to qualify, no problem, either way. You know what, Chris? I haven't looked into it. It's not necessarily. What they do? They said within 60 days they're going to cancel all their. Is it equity lines, or was it something else? I probably shouldn't speak on it. I haven't really done the proper research. Cancels credit. It's personal lines of credit. I thought. I didn't think it was HELOCs. And so, take it for what it's worth. There's going to be plenty of people that are like speculating on what this means and, oh, this happened before the last crash and they know something we don't and all this other stuff. I probably wouldn't, put too much stock into it, but, they just, as a business, are deciding that, personal lines of credit they want to get out of. And I think that's what it is. I don't think it's HELOCs. Home equity line of credit, which you stated, and personal line of credit, totally different things. And I just Googled it real quick just to make sure that I was correct. And they're going to close personal lines of credit within 60 days. I mean, the biggest news, I think, is a lot of people like, your credit score is going to go down because your account's going to be closed. And when accounts are closed, credit suffers. Not true. I mean, I wasn't saying that B of A had a second. I'm saying that some of the down payment assistance that are state ones, that their programs might have a second or a third. If this one doesn't have a second, then great. It looks like they just give you a 1099. So you're going to pay taxes on the assistance they give you, which, I mean, there's plenty of programs that I'm not going to say that they're all bad. It might be a great one, similar fees. And it sounds like, down payment's a grant. You just pay taxes on it. The only thing you're going to have to look out for is like, how quick can they close it? And if you're in a competitive market, can you get an offer accepted on a 45-day close? If you can, great. Best of luck to you. I have rental income for the past 2 years and recently went full-time 1099 as a real estate agent in 2020. Will I be bankable in 2022? If so 2020 on your Schedule C, which you're going to have, real estate consultant or whatever it is, you're going to have a top line of all the real estate you sold minus all the expenses. Then your bottom line, like line 31 or 32, is going to be the net, right? You're going to have the gross of all the commission that you got, and then expenses, net. Let's say in 2020, it's $32,000. You sold 14 houses, you made $100,000. You wrote a bunch of stuff off. I mean, depending on what market you're in, maybe you made $60,000, wrote some stuff off, 32. Then in 2021, you crush it. You sell 50 houses. Your top line is 310, and then you have some write-offs and you make 240. Man, I had you pretty steep learning curve, right? Maybe that was ambitious, but they're going to take the average of those 2 years. And so not so good first year, excellent second year. Those 24 months, you made $270K. You're going to apply for a loan after you file 2021. And that average is going to be $11,000 a month. You're going to have to show a P&L that those first 3 months of the year, which for a real estate agent might be tough if those 3 months are not as good as like the average. If loan guidelines are similar to how they are today, they want you to show a P&L that shows you're on track to make as much as last year. And so, it's going to be a 24-month average or maybe a 27-month average with the 2 years tax returns and the P&L. Really, like it's ever evolving, right? And we never had to use current P&Ls to prove that the business is still operating at the same capacity or at the same speed or at the same income levels than before. But that's something that's come along because of COVID. So just count on a 2-year average. And so the 20 and 21, like bottom line net income, get that as high as possible. I mean, I know it's true when the discussion of buy versus rent comes up. There was something I saw that rents were increasing faster than home prices. Rents are going bananas in a lot of markets. And when you get into a 30-year fixed rate mortgage, yeah, maybe your payment's $1,820 and you could rent that house for $1,600. But where are you going to be in 5 years? Where are you going to be in 10 years when that house rents for $2,400 and your payment's still $1,820 on a mortgage? Great point, Brian. Great point. Basilio, ¿cómo estás? Can you contest appraisal when doing a cash out refi on investment property if the appraisal report is not what you're expecting? You can always contest it. Whether or not you're going to win or get value reconsideration is another thing, because it's just appraisers, like most professionals, have some pride, and they come out and they say 320 is the value. And you're like, bro, you're way off. This thing's worth at least 360. And you show them that comp and that comp. To have them do, it's called you submit for, it's coming. Hold on. More coffee. Reconsideration of value. I think it's that, right? To have them actually go in and revise their report, they're having to say, my bad, I messed up, I made a mistake. Humans don't like to do that. So they're going to go in there and be like, no, you know what? Look at this comp for 290. Look at this one for 330. My 320 is spot on. Boom. And literally that happens more often than not, where it's just, well, I've got one going right now. It's an absolute disaster of an appraisal. This guy bought this place for 460, added 2 ADUs. It cost him $200,000. They tried to appraise it at 530. One, the market's increased enough where it's probably worth more than 530 without the ADUs. With the ADUs, it's worth 750. I know we're not going to get an appraisal reconsideration to go $200,000 higher, which is what we truly need. I just took it to a new lender. It's the beauty of being a broker. New lender, new appraisal. Let's go. So that's, I'm not going to say this out loud, but the proof is in the pudding. Loan officers in general. No, I shouldn't say that. I know some cool real estate agents. There's some cool ones. I only work with the cool ones. I don't work with the not cool ones. Will, I got your back, man. Keep coming back. I'll always have your back until I retire. Then I'm out. Then I'm on the beach with my family, and you're on your own. You got a decade. You got a decade of me. I'm gonna be around for the next decade, growing like a $500 million a year mortgage company. Then I'm gonna sail off in the sunset. Basilio. There is different like small banks. And this is where a relationship with a small bank really comes in handy. They'll do these portfolio loans where you wrap them all together. And from what I've seen, you're probably paying like 4.5%. But if you've got a portfolio of $2 million in real estate and you owe $900,000 on it, you just wrap that whole $900,000 in a portfolio loan, and the bank's going to, let you borrow that money at 4.25%. I've seen it like in that range, like low fours. It's got to be like less than 60%. of that $2 million. So you can't be leveraged up in this stuff because those portfolio loans are fairly conservative. But you do that, you put them all into that portfolio loan. Then you've got no debt on those. Besides that portfolio loan, you can go out and get yourself 10 new conventional loans at those smoking 2.875 or maybe an investment at 3.375. That's what I've seen. That's the best way to do it. After purchasing a new investment property via 1031 exchange, what is the seasoning period to a cash out refi? You could do a immediate cash out refi when you buy an investment property, whether it's 1031, whether it's cash, however you buy it. If you do it within 6 months, your loan amount max is the purchase price. And so, if you bought it for 300 and it's worth 400, you couldn't do, or let's say it's worth 500, right? You couldn't do a refinance for more than the 300 you bought it for. If you wait 6 months and you got this smoking deal, or you did rehab, or you did whatever you wanted to do, and it's worth 500, then you could do a loan up to 75% cash out on an investment, right? And then you get 375. And so in the case where I work with investors where they bought it for 300, they put in 40,000 in rehab and it's worth 5, they could burr plus a little kicker, right? Because they can go up to 375 loan amount. I think that's what you're talking about. And so delayed financing is what it's called if it's within that 6 month period. If you wait 6 months, then it's just a cash out refi where you can go up to 75% of the new appraised value. Forbearance, Kimberly. Somebody mentioned forbearance. I'd love to clarify for you that if you are currently having trouble paying your mortgage payment, if you're a homeowner with a mortgage and you were laid off, you've got financial trouble because of the folks in fact impacted by COVID, they came out with a forbearance program, meaning you can delay paying your mortgage payment. And I say delay because you're going to have to pay that eventually, pay it back, but you might enter into forbearance for 6 months or 12 months, meaning you're not going to pay your mortgage payment. When that forbearance period ends, you're going to talk to your servicer and either pay all of it back, or the more common thing is you're going to attach that amount of missed payments that you have. Let's say it's $20,000 in missed payments to the back of your loan. Holy moly, we've been going for 2 hours. I said an hour and a half. Now it's time for the speed round. I'm going to get through as many questions as possible. I'm going to get home to my family because they are missing me. I took what the mortgage guy said to me, that we pay $2,000 for the rate lock and we owe $24,000. We would then only owe. Doesn't sound right. Like you're paying it out of pocket right now? I don't like it. I don't know. Get clarification from him. Send me an email, matt@mattthemortgageguy.com. I'll check you out. If you pay off a mortgage years early, is there usual penalties? Not on most mortgages. No prepayment penalties on most any mortgage that I'm writing nowadays. Venice Beach, 2022. Sweet. I live in San Diego, and you can almost guarantee landlords will go up. I'm glad my escrow is closing in a week. Oh, for sure. I mean, rents are bananas in Sacramento where I'm at. Bananas. 11 p.m. in Indiana. That's all you got? Is 11 o'clock? I'm tired too. I'm getting out of here soon. Thanks for joining, Jennifer. I appreciate you. Kimberly, I appreciate you. Thanks for joining us. Basilio, you both have W-2 jobs. In theory, we should be eligible for up to 10 conventional loans each, right? Correct. If you can qualify. I mean, depending on how much your income is, you've got to qualify. And the second, third, fourth, and fifth, it becomes increasingly hard because, truth be told, on your taxes, how much rental income you receive on the rental property to offset the mortgage, it's going to become increasingly hard. Once you have a $2,500 primary, a $1,500 rental, $1,400, $1,700, like as you stack up those mortgage payments, if you guys each make $400,000 on a W-2, you're good to go. Probably do 10 of them, no problem. If you make $82,000 on a W-2, it's going to become hard to, get those 10 each on your own. De nada, Angel. Nos vemos El próximo lunes. Yep, I'm going to my family. I'm out of here. You're pre-approved for over 300,000. What would the highest pre-approval likely be? You got to ask them. Usually they should put in some buffer. If you're talking to me and I'm your mortgage guy, I'm going to be like, you're good to about 315. Knowing in my head, it's probably 325. Also knowing that if rates go from 3 or 2.875 to 3.25, that 315 pre-approval is going to shrink to 300 or 305. Thanks, everybody. I appreciate you. I went 2 hours because we're having so much fun. Thanks for joining. Hope to see you here next week. Until next time.